Anthropic's 3.5 gigawatt power play, how Google built a toll road and called it a partnership. The official story. Anthropic just announced a massive expansion of its compute partnership with Google and Broadcom, securing 3.5 gigawatts of next-generation TPU capacity. The company's revenue has tripled from $9 billion to $30 billion in just 4 months. CEO Dario Amodei called it a historic moment for American AI infrastructure. Wall Street celebrated. Broadcom shares jumped 6%. Everyone is winning, apparently. Except when everyone is winning, someone is paying. And when the compute bill comes due, the question isn't who built the best AI. It's who owns the power plant. What's actually happening? Let's start with the numbers that should make you uncomfortable. Anthropic has raised nearly $64 billion since its founding in 2021. Its latest Series G round in February 2026, led by GIC, Koachu, D. Shaw, and Founders Fund, brought in $30 billion at a $380 billion post-money valuation. That makes it the second largest venture funding deal in history, behind only OpenAI's $40 billion round. Now here's where it gets interesting. Google owns 14% of Anthropic. Google has invested over $3 billion in the company. And Google is also the company selling Anthropic tens of billions of dollars worth of TPU compute chips through this new deal. Read that again. Google is both investor and vendor. Google owns a piece of the company, and Google also sends that company the bill for the electricity that keeps the lights on. This isn't a partnership. It's a vertically integrated dependency wrapped in press release language about expanding American AI infrastructure. The 3.5 gigawatt deal triples the October 2025 agreement that gave Anthropic access to 1 million TPUs at over 1 gigawatt. The new capacity starts coming online in 2027 and extends through 2031, with Broadcom committed to designing and supplying future generations of Google's TPUs for the entire period. That's a 5-year hardware lock-in disguised as a strategic expansion. And here's the clause that tells you everything. Broadcom disclosed that full utilization of the 3.5 gigawatt capacity is contingent on Anthropic's continued commercial success. Translation: if Anthropic stops growing, the deal shrinks. If Anthropic keeps growing, Google and Broadcom extract more revenue. The house wins either way. Meanwhile, Google's own Gemini competes directly with Claude in every enterprise market segment. Google is literally funding its own competitor's server bill while also competing for the same customers. This isn't a conflict of interest. It's the business model. The evidence trail. Follow the money through 3 layers. Layer 1, the funding circularity. Anthropic raises $30 billion from investors in February 2026. A significant portion of that capital will flow directly to Google Cloud as compute payments. Google, which owns 14% of Anthropic, essentially gets a return on its equity investment through compute revenue. The investor is also the vendor. The investment isn't just equity appreciation. It's guaranteed revenue. Microsoft did the same thing with OpenAI. Invested $13 billion, then made OpenAI run exclusively on Azure. Every dollar OpenAI raised eventually flowed back to Microsoft as cloud spending. Google is now running the same playbook with Anthropic, except Google was careful to limit its stake to under 15% to avoid triggering antitrust scrutiny. No voting rights. No board seats. Plausible deniability on paper. Layer 2, the Broadcom angle. Broadcom is the quiet kingmaker. The company designs Google's TPUs, the actual silicon that powers everything. CEO Hock Tan projects $100 billion in AI chip revenue by 2027. Broadcom's deal with Google to design TPU chips extends through 2031. That's a 6-year monopoly on the chip architecture that Anthropic is locked into. Think about what that means. Anthropic can't switch to NVIDIA GPUs without rewriting their entire training stack. They can't move to Amazon's Trainium without losing the performance optimizations built for TPU architecture. And they certainly can't build their own chips. The switching costs are astronomical. Broadcom and Google have built a compute prison and convinced Anthropic to sign a 5-year lease. Layer 3, the revenue Mirage. Anthropic's run rate jumped from $9 billion to $30 billion in 4 months. That's a 233% increase. Over 1,000 enterprise customers now spend more than $1 million annually, doubling from 500 at the time of the Series G in February. These numbers are real, and they're impressive. But revenue is not profit. Anthropic is spending the vast majority of that $30 billion run rate on compute. Industry estimates suggest that frontier AI companies spend between 60 and 80% of revenue on infrastructure. If Anthropic is spending 70% on compute, that's $21 billion a year flowing to Google and hardware providers. The company raised $30 billion in equity and it's burning through compute at $21 billion per year. The math only works if the revenue keeps tripling. And revenue never keeps tripling. Why this framing serves them? Every party in this deal has a reason to frame it as a partnership rather than what it actually is, a dependency chain. For Anthropic, the narrative is about scale and ambition. We need 3.5 gigawatts because demand for Claude is exploding. That's true. But it also locks them into Google's ecosystem for the rest of the decade. Dario Amodei can't publicly acknowledge that his company's cost structure is controlled by an entity that competes with him. So instead, it's a historic partnership. For Google, the narrative is about being the picks and shovels provider. Sundar Pichai recently said that AI shift opens opportunities to invest in startups. That CEO speak for, we don't need to win the model race if we own the power grid. Google's Gemini can be the second or third best model, and Google still wins because every frontier AI company is running on TPUs or Google Cloud. It's the AWS playbook, except Google also owns a chunk of the companies paying rent. For Broadcom, the framing is simpler. They don't need a narrative. They just need the contracts. Hock Tan's strategy has always been about locking in long-term silicon supply agreements. The TPU design contract through 2031 guarantees Broadcom revenue regardless of which AI company wins the model race. Whether it's Anthropic or Google or both, Broadcom makes the chips. And for Wall Street, the narrative is about a massive total addressable market. A $380 billion valuation for a company with $30 billion in revenue gives a price-to-sales ratio of about 12.7 times. That's not insane by tech standards, but it assumes Anthropic will continue its current growth trajectory. The moment growth slows, that valuation becomes indefensible. And the consumption clause in the Broadcom deal means that even Anthropic's chip supplier is hedging against that outcome. The Department of Justice has noticed. The DOJ has proposed that Google divest its stakes in generative AI firms, including Anthropic. This is the regulators recognizing what the market hasn't. When your chip supplier, your cloud provider, and your equity investor are all the same company, that's not a partnership. That's a choke point. What happens next? 3 scenarios are converging. First, the DOJ antitrust case against Google will likely force some kind of restructuring of the Google-Anthropic relationship. If Google is forced to divest its 14% stake, the compute deal becomes even more revealing. Without the equity relationship to justify preferential pricing, the commercial terms of the TPU deal will be exposed to market scrutiny. If Anthropic is paying market rates, the economics might not work. If they're getting below market rates because of the equity relationship, that's exactly the kind of vertical integration the DOJ is targeting. Second, Anthropic's burn rate is unsustainable without continuous fundraising. The company has raised $64 billion total. It's spending roughly $21 billion per year on compute alone. Even with a $30 billion revenue run rate, the margins are razor thin. The next 12 to 18 months will determine whether Anthropic can build enough enterprise recurring revenue to become self-sustaining, or whether it will need yet another mega round. At some point, even venture capital reaches its limits. Third, the TPU lock-in creates a single point of failure. If Google's TPU roadmap falters, or if Broadcom's manufacturing encounters delays, Anthropic has no fallback. The company talks about a diversified compute strategy across TPUs, Trainium, and NVIDIA GPUs, with Amazon as its primary training partner. But this deal puts 3.5 gigawatts of capacity exclusively on Google's architecture. That's not diversification. That's concentration dressed up in partnership language. The broader implication is systemic. We're watching the AI industry consolidate into a handful of vertically integrated stacks, where the chipmaker, cloud provider, investor, and competitor are often the same company. Google and Anthropic. Microsoft and OpenAI. Amazon and Anthropic again. These aren't partnerships. They're dependencies. And when the next downturn hits, the company that owns the power plant will decide who keeps the lights on. What you should do about it. If you're building on Claude or any frontier AI model, understand that your vendor's cost structure is controlled by their cloud provider. Anthropic's pricing stability depends on Google's willingness to offer favorable compute terms. That's a risk factor. If you're investing in AI companies, look past the revenue headlines. A $30 billion run rate means nothing if 70% flows immediately to infrastructure providers. The real metric is gross margin, and nobody in frontier AI is publishing theirs. If you work in the AI industry, recognize that the partnership era is ending. What's emerging is a compute oligopoly where 3 to 4 companies control the infrastructure that every AI application depends on. Google, Microsoft, Amazon, and Broadcom behind the scenes. Your career and your company's future are downstream of their capital allocation decisions. And if you're a regulator, the Anthropic-Google relationship is the template for what's coming across the entire industry. The company that sells you the chips, runs your cloud, owns your equity, and competes with your product is not your partner. It's your landlord. And landlords have a way of raising the rent.